This is the Alhambra Investments Weekly Market Pulse. Today is September 27th. Joe Calhoun is here. And Joe, first thing I want to talk about, I don't want to spend a lot of time on it. We talked about the Chinese company Evergrande last week. And in fact, the day we recorded last Monday, market just tanked over fears. But in your report this week, one of the things you indicate is it's probably not as big a deal as a lot of people want to make it out to be.
Well, and the market figured that out pretty quick, right? I mean, think at the low on Monday last week, you were down 1,000 points or close to it. It closed down 600 and something, but by the end of the week, you're back to flat, maybe even up a little bit on the week. I think we actually finished up a little bit on the week on the S&P. But it doesn't matter. I mean, look, the market figured it out. We get these little spasms occasionally where people overreact to things. That's what provides opportunity in markets. That's just the way it works. And look, this Evergrande thing, don't want to say it's nothing because I think it is something, but I think it's something for China. I don't find any connections to the global financial system. I don't think there's any U.S. banks with exposure here. All the typical ones that we would expect to have a problem, like HSBC and Credit Suisse and UBS, the Swiss banks, none of them are reporting anything big. HSBC actually stopped financing Evergrande projects like 3 months ago. So it's just not exactly news. But look, China's slowing down, and it has been slowing down. And the things that she has been doing over the last few months, I think it's interesting, people thinking about it. And we've talked about it a little bit internally, and I think we might have even talked about it on one of these podcasts. Look, I didn't really think about or don't really know what she is doing, but whatever he's doing is not going to be good for growth. Evergrande is a very large company. He's not going to, who knows exactly who all is going to take a hit there. But the bottom line is that it's going to create slower growth in China. Whether that's a good or bad thing, I don't know. But as I said in the piece, I'm old enough to remember when Japan blew up their real estate bubble in the early 90s. And Japan at the time was just as big a deal as China is today. And everybody was worried about the blowback to the global economy, and Japan suffered for a decade or more, and the rest of the world went on about their business. Will this be the same thing? Could be. As I said, too, I think there actually could be some positive out of it. Look, if China's been wasting natural resources like copper and iron ore and so forth, building things that people don't need, then maybe if they stop building things that they don't need, that those prices will come down, and some other countries will benefit from those lower prices. So look, I'm not going to prejudge it. I don't know how it's going to come out, but it doesn't look like any financial problem.
Well, let's talk about what was a much bigger story last week. Nice jump in 10-year treasury yields at the end of the week.
Yeah, look, we've been talking about this for a while. If you remember back in the spring, when rates were hitting 175 and started to fall back, we talked about it. It was like, look, you could fall all the way down to about 120 and still be in an uptrend. Does it mean anything? Well, we had a little bit of a slowdown. Frankly, I don't even think the slowdown was that great, but we had a little bit of a slowdown in the reopening phase of this recovery from COVID. The Delta variant came along and kind of slowed things down a little bit. And I think what's happening now is that slowdown is done. Look at the durable goods orders just this morning. Look pretty good. Durable goods were up much more than expected. A lot of that was Boeing. I get that, but it was even positive if you take out the aircraft orders. Capital goods orders were quite good. Up 0.5 on capital goods, ex defense, ex aircraft, and actually just ex defense capital goods orders were up 9%. That's a big number. So I think people are going to start pricing in the end of the Delta variant. It doesn't really matter whether the impact from Delta was that great or not. What matters here is that people perceive that it had a big impact, and that as it fades, that people are going to get back to doing things. Look, we know it's had some impact. Airlines talked about people canceling trips and so forth, but how big it is, I don't know. I think people are going to start to price in a reacceleration here from the end of that. But there's a lot of things between here and nirvana as far as growth is concerned. We've got a lot of things working its way through Congress with these spending bills and tax bills and so forth. We don't know how that's going to come out. So look, it's a positive. Rates going up is generally a rise in growth expectations. That's what we saw last week. Inflation expectations, if you're looking at The market-derived inflation expectations, looking at TIPS and nominal bonds, was unchanged on the week. So real rates went up just as much as nominal rates did. That's a positive sign. So we'll see. Like I said, what we're seeing now is a shift, which we would expect. Again, something we've talked about with our four quadrants about what the dollar is doing and what growth is doing. And this reacceleration here means that we're getting a little bit of a shift back to value. Financials and energy are performing very strongly this morning. The value indexes on the S&P are up this morning while the growth indexes are down. That's just normal and expected. We're positioned for it. We feel good about it. We'll see how far it goes. I don't want to get too far ahead of ourselves here. The 10-year Treasury note is still trading at 147. It's not like it's pricing in some great growth. It's just pricing in somewhat better than it was a few months ago.
It seems that there's still not a lot of movement in the dollar, that overall we're where we've been for 6-7 months now.
Yeah, it's interesting. I classify the dollar as in a short-term uptrend here, but in reality, it's at the bottom end of a range that we've been in for 6 years. It just doesn't move. And remember, the dollar index is going to move based on relative growth expectations. So the dollar relative to growth, U.S. growth relative to, say, European growth, that expectation hasn't changed. And I think part of that is that U.S. growth expectations fell a little bit, European growth expectations rose a little bit. It just seems like that we're stuck in this range. And by the way, it's not a bad thing. I find it interesting that we've had really a pretty stable dollar for 10 years now. To me, that's what monetary policy ought to be aiming for. So the fact that we've achieved it, I'm not sure people really understand that this is a good thing. A lack of currency volatility is good. When we've seen crises in the past, it's because currency volatility went up a lot, generally with the dollar rising. But we also have seen crises develop over the years. And actually, I guess the seeds for the crises are often sown when the dollar's falling. So this volatility is what the problem is. The stability is actually a good thing. Then you can really concentrate on what's going on in the real economy. So I don't know. It is what it is. It makes our job a little bit more difficult. You get these little short-term trends of up and down, and you kind of try to play those a little bit. But in general, I think it just means you get back to the more basics of investing, looking at companies, looking at markets, and thinking about the fundamentals, which is what we seem to be pretty good at.
We've talked a lot about one of the hardest things in investing is knowing when to wait. Is that where we are now? Is this a good time to wait? Or are there things that selectively, if you do your research, you can still find some good deals?
Well, look, I think that value is still cheap, certainly relative to growth, but just cheap in general. And so assuming that the economy is not falling off a cliff, which it doesn't appear to be, value should do better here. I think there's an opportunity in value, whether it's, and it does, you know what, let me just say this too. With the dollar stable, I don't think it really matters all that much whether you're talking about U.S. value or international value. I think they're both going to start to outperform here. We had started that value outperformance earlier in the year, and then it faded. We gave about half of it back, and I think we're going to get another leg higher here. If I'm right, if rates keep going up and if growth expectations do continue to rise, that's what we would expect. And so I think there is an opportunity in value. From a sector basis, again, we're long financials. We're not long energy right now, which is, I'm kind of kicking myself on that one, but it's okay. We played energy on the first leg up, and now it looks like we're getting another leg up. Oil's trying to break out above 75 on the crude side. So, we may do something with energy later, but financials look good. Biotech and healthcare continue to look good, which we're long there as well. So, I think there are opportunities, but I think it is very selective. I don't want to own the S&P 500 here. But I can own S&P 500 value. I can own the dividend indexes too, by the way, which are also kind of value oriented and outperforming again today. So I think there are opportunities. There's still money out there that people want to put to work. Savings account still not getting you anywhere. So I think money is going to keep coming in this market. Where it goes exactly in the market is kind of what we're trying to figure out. And I think that's part of the answer is value.